Let's look at source document, records, and books of account. Source documents, records, and books of account. What do we mean by source document first? Source documents are books of evidence to transactions recorded in the books of account. For every transaction to be recorded, or for any transaction to be recorded in any books of account, there must be books of evidence to that transaction. So those books of evidence to transactions recorded are known as source documents. They are: 1. Quotation. A business makes a written offer to customers to produce or deliver goods or services for a certain amount of money. That is what we call quotation. 2. Sales order is a source document, and a sales order is a customer write out or signed an order for goods or services he requires. Also, we have purchase order as also a source document. A business orders from another business goods and services such as material supplies. So purchase order is a source document. Goods received note is also a source document, and a good received note is a list of goods that a business has received from a supplier. So that is what we call a what? That's what we call a good received what? Note. And this is usually prepared by the business owned warehouse or goods receiving what? Goods receiving area. So they are usually prepared by what? By a firm warehouse or business owned warehouse or goods receive what? Area. Then we have what we call goods dispatch note. A list of goods that what a business has sent out to customers. We have what we call an invoice. An invoice set out the full details of goods sent by the supplier, to the buyers, stating the quantity, price, and discount given, and terms of what? Terms of payments. We also have a petty cash voucher. A petty cash voucher covers payment credited to the petty cash book. So it's a major source document to petty cash book. So that is petty cash as a source what? As a source document. We also have what we call statement of account, a document sent out by a supplier to a customer listing all invoices, credit notes, and payment received from the customer. We also have what we call the credit notes as a source document. A credit note is a document sent by a supplier to a customer in respect of goods returned or overpayment made by the customer. You must know the basis of sending a credit note is based on goods returned, because money will not be refunded or there is an overpayment. Debit note is the opposite, a direct opposite of debit notes. A debit note is a direct opposite of credit notes. A debit note is a document sent by the customer to a supplier in respect of goods returned or an overpayment overpayment made. Sent by what? Sent by a customer to a supplier. Okay, so that is a debit what? A debit note. So it is a formal request for the suppliers to what? To issue a what? to issue a credit note in that respect. Okay, we have remittance advice. Alternatively, a debit note is also issued by a supplier to a customer for underpayment. Also take note of that. So remittance advice, a document sent with a payment details which invoices are being paid and which credit notes are also offset. We call it a remittance advice. Then we have receipt. A receipt is a document that acknowledges acknowledges payment. So a receipt is a document that acknowledges payment. So this is usually is written confirmation that money has been paid, and this is usually in respect of cash sales. For instance, e.g., a till received from a cash register. So that is what we call the source documents. They are books of evidence. Once again, receipt is one of them. Remittance advice is one of them. Debit note, credit note, credit note, statement of account, petty cash voucher, invoice, goods dispatch note, goods received note, and purchase order, sales order, then quotations. These are what we call source documents. It should be noted that the two books are very necessary. It should be noted that two books are very necessary in the recording of financial transactions, be it a credit transaction or a cash transaction. All transactions must pass through the books of account. And as a result, it is necessary we look at these books of account together. The first books of account, the first one is what we call the subsidiary books. The subsidiary books. And we have the principal book. The principal books. The subsidiary books are sometimes referred to as a book of prime entry, or what we call the books of original entry. But before we look at the principal book, which is the ultimate book, but we must look at what we mean by the subsidiary books of account. So let's go in by looking at the subsidiary books of account. The subsidiary books of account is a book of first entry in which transactions are recorded first before they are being transferred to the principal book. And the principal book here is ledger. So the subsidiary book is also called the books of original entry or books of prime entry. What are they? They are sales day book, purchases day book, sales return day book, purchases returns day book, journals, cash book, and finally petty cash book. These are the books of what? Books of original entry or prime entry, or what we call the subsidiary books of accounts. Now let's look at them in a tabular form. Subsidiary books and their source documents. Remember, we just finished just documents earlier on. For purchases day book, the source document to it is incoming invoice and debit note received. The sales day book outgoing invoice or debit note issued, sales return day book, credit note sent out, purchases return day book, incoming credit notes, cash book, the source document is till slip, incoming checks, receipts, check counterfoils, and petty cash book. We have petty cash voucher as the source documents. This is examinable, it is testable in the exam. You must note the source documents to each of the words subsidiary books of account. Let's consider the reasons for subsidiary books of account. One of the reasons for subsidiary books of account is that to know the total sales or purchases. We want to know the total sales or purchases. Number 3 is that what? They are used as books to make first entry. I've told you they are first entry transaction books. Number 9 is to keep track of people whom money is owed to. That is, we want to see the creditors, or what we call our payables. We want to know our payables. Then, to know whom what money is owed, and of the people who owe money. This want to also know our, want to know the, usually you call it debtors, but with IFRS we call it receivables. We want to know our receivables, those who owe the company, and those who the company is owing, which is called the payables. So these are the major reasons, the 3 major reasons for the subsidiary books of account. So we shall take these subsidiary books of account one after the other. Let's consider the first subsidiary books of account, which is our sales day book or sales journal. It is used in recording goods sold on credit to customers. So this is a book of original entry in which credit sales are recorded before being posted to the sales before being posted to the principal book, which is a ledger. So in the sales day book, cash transaction must not be recorded. You must take note, we use it for recording credit transaction, credit sales only. Equally, sales of fixed assets must not be excluded from the word. Must be excluded also from the word, from the day book. So for any sales of fixed asset, or what we call the non-current asset, we use the journal to answer that. So the sales journal is not part of the double entry. All the day books are not part of the double entry, except the cash book, which is the only subsidiary book that allows for double entry. So the seller will be the seller will enter the sales journal from the sales invoice. So how does posting look like? So the by the time we draw up a sales journal, the total of sales in the sales journal will be transferred to the credit side of the sales account. So we take it to the the credit side of the sales account. So the total in sales journal will be transferred to credit side. So credit sales account, and various customers account. So various customers account will be debited. So take note of that. And there's a need for us to also recognize what we call trade discount. There's what we call trade discount. A trade discount is given to a customer in order to ensure bulk purchasing. bulk purchasing. So it is deducted at source before telling the customer the actual amount is owing. So this the trade discount is the allowance of the selling price or catalog or price of goods supply. So it is normally given to the buyer by manufacturer. So trade discount are simply a percentage of deduction from the retail prices. Therefore, no entry for it should be made in the double entry record. So it's deducted at source, before arriving at the amount the customer is owing. So trade discount differ from cash discount, but later on we'll be looking at the distinction between trade discount and cash discount. Trade discount is given at source, while cash discount is given to encourage customers to make payment promptly. Okay, so beg your pardon. So that is the sales day book. We use the recording goods sold on credit. The total amount of credit sales will be transferred to the credit side of sales account, and the various customer accounts will be debited. So for instance, this is a specimen. This is how our sales day book will look like. We'll have our date, we'll have our particulars, then we have our folio, which is used for referencing. We have our details, and we have our total amount. So this is the specimen of our sales day book. So this is the specimens. By the time we find the total here, the total sum here will be credited to sales account. So we'll just come here, sales account. On the credit side, we'll tag it as what? As sundry. We'll put it there. Then the various customers account, customers account will then be what? Be debited with their various value. We'll just come here, let's say January sales, debit the customers with their various amounts. So there is a question we have, and let's quickly use that question as a case study to sales day book. Enter the following transactions of Mercy Enterprise in the sales day book for the month of January 2014. January 1st, 2014, sold goods to Henry, 20 bags of sugar at 40 each, 12 plates at 140 each. And January 12, 2014, sold goods to Musti, 12 bags of cement at 45 naira each, 5 packets of tea at 15 naira each, and presented with a trade discount at 10%. Trade discount at 10%. So the trade discount at 10% is for Musti, whereas Mercy Enterprise is not having any form of discount available to it. So let's quickly solve that. So this will be the solution. Our specimen is this: sales day book. We have date, we have particulars, we have folio, we have details, then we have total. So the date is January 1st, 2014. The first person transaction there is Henry. We have Henry. What happened to Henry? To Henry, we have a sales of 20 bags. 20 bags of sugar at 40 naira each, and that will give us 20 by 40 times 40, that is 800. So that is 800. Then the next is 12 plates. 12 plates at 140 naira. 140 naira each, and that is 12 times 140, and that will give us 1,680. 1,680. So the total transaction of Henry is 2,480. Okay. So we now have January. The next date is January 12, 2014, and that is we have Musti as the customer. 12 bags of cement. So 12 bags of cement at 45 naira each, and that will give us 12 times 45. That will give us 540. And here we have 5 packets of tea. 5 packets of tea at 15 naira. So 15 times 5, and that is 75. If you total this, our total here is 615. 615. Then less trade discount. Less trade discount of our trade discount is 10%. Is it 10%? Yes. Our trade discount is 10%. So in a bracket, 10% of 615. The 10% of 615 is going to be 62 approximately. So when we less that, we are going to have 553. The total here is 2,480. So when we add 2,480 plus 553, it will give us a total of 30,033. So this is what we are transferring. We say transfer to sales account. So this is the total we are transferring to sales account. So in the next page, we'll come here, we'll have sales account. Hang the naira. You come here, that will be the last date, January 31st. We shall say it is what? Sundry. sundry, and that is 3,033. So this is for the year 2014. Then the various customers accounts will be open. We have Mercy account. Okay, then we also have Musti account. What do we say? We say the various customers account will be what? Will be debited 2014 for Mercy. It is January. For Musti it is January 1st. For Musti it is January 12th. So January 1st, then 2014 January 12th. Sales. The value for Mercy is 2480, and the value for Musti is 553. So this is how it will go. And I said, remember the total here is 3,330. So that is for sales day book.